give you the transparency on how we're looking at how to establish a position like the ones we've talked in the past, whether it's a poor man's covered call, a cover call, a put diagonal spread, or a call diagonal spread. But before we jump into that, let's just take a look at the midday markets. Right now, you currently see that the market is continuing to stay in the red. You have the NASDAQ composite, the Dow Jones, the Russell 2000, as well as the S&P 500, all under pressure right now. You can see they're basically at the same levels they've been all day, in the red. Volatility as well, in the red. And you also have commodities mixed. You have the dollar up, you have crude as well as materials down, and then you have retail up. So mixed market at best, more on the downside, some uncertainty. But with that being said, I wanted to take a look at an approach that I think a lot of people could take advantage of right now, especially as we start to see more volatile moves potentially on the forefront. Looking at doing credit strategies. So now, for those of you that are new, this is going to be a little bit over your head, but it doesn't mean that it doesn't warrant you taking a look at this strategy. You can go back and review this, and we're going to expound on this in the, you'll see some information in the section of live videos where we're going to do more of these. So let's take a look at the put credit spread, and really we'll give you the setup for the put credit spread, and then we're going to actually jump in and take a look at just an example. These are all just examples and concepts. I don't want anybody running out and trading this until you do your due diligence and you really understand the risk and reward factors. So when do you use, or why would you use a put credit spread? Well, if you think that a stock is going to continue to trade basically flat or in a very slight uptrend, and you've had a recent pullback, think the stock's going to stay there. You could generate some income. In other words, increase your yield on your portfolio with a fixed risk opportunity by selling a put credit spread. The mechanics of this are very straightforward. You're selling a put with a higher strike price than the put that you're buying. So you're receiving a credit for the sale. That's your yield, right, or your income. And you want to have that risk fixed. In other words, when you sell puts, you're saying that you do not believe that the market is going to go below that strike price. Now, there is no 100% certainty that it will not challenge that, will not go through that, or will not just basically blow through to the downside, okay? So because you don't want to have that risk to the downside, you want to buy this option to hedge yourself. The risk is the difference between the width of these strikes minus the premium you receive, okay? And if the stock stays above that short strike price between now and expiration, you get to keep that credit. So what are the critical setup components for a bull put spread or a put credit spread? First of all, your market outlook is it could be slightly bullish, neutral, or sideways. You're looking to basically say, hey, I don't want to purchase this stock right now. I definitely don't want to own it if it breaks through this price level of the put I'm selling. But I do believe that the short-term or mid-term thesis is that the stock is going to stay above that strike price. So I want to have a fixed risk type of opportunity if I'm going to put that risk capital out there during that time period. And you're willing to receive for that fixed risk a limited reward, or in other words, a reward that you are going to realize the moment that you actually execute the trade. One other thing that you want to remember about put credit spreads is that it's an opportunity to potentially increase the yield in your account without exponentially increasing the capital risk that you have in the market. So the stock that I want to take a look at as an example is going to be AMAT, A-M-A-T. Now what I'm looking at right here is the seasonal chart for AMAT, okay? I chose AMAT just off the cuff. It's a stock that I have watched in the past. And as a matter of fact, if you actually look at Applied Materials, from a chart perspective, the stock has been moving unbelievably well. It's at a 52-week high. It's been basically on everyone's radar. But what's notable here is that it's kind of petered out up at this level. Now it's well above its 20, its 50, and its 200-day moving average. As a matter of fact, the 20-day moving average comes in at $24. The stock's trading at 36 and some change. So you can clearly see a really nice uptrend. The bulls are wholeheartedly in control here. So you're looking at a stock that is bullish, might have the potential to pull back after a pretty decent run, but you're looking to take advantage of maybe a pop in implied volatility, maybe some, basically neutral to slightly bullish action happening here, but it might consolidate for a while. So how do you take advantage of that? Because you're not ready to purchase the stock outright. Here's the put credit spread. One thing that you can do is you can go in and take a look at the correlation charts. That's actually right under here under the premium toolbox. If you look at the seasonal charts, you can bring those up. Now the seasonal chart is saying that the current price action has a 92% correlation. So the current price action has a 92% correlation to its seasonal moves, right? Now this basically looks back as far as, I believe this one goes back to 1990 as far as price action. And the one thing that you'll notice about this green line, which is the correlation line, is that it's basically flat. And again, the correlation coefficient is between the annual seasonal graph and the current graph, okay? It includes 90, and always includes at least the past 90 days, and it looks back in this case as far as 1990. Now, correlation of 70% or higher indicates a high statistical probability that the current graph will follow the seasonal graph. And one thing that we noted about put credit spreads is we want to have a market that we believe is either going to be slightly bullish to neutral. And you can see that this is relatively neutral as we get into March. Now, yes, there could be a pullback here. We're seeing that. We've seen that the stock is actually extending when you look at the chart. So this may not be the perfect time to put this on, but we want to look at the setup, okay? And you can see basically through April, May, and June, the seasonality chart is showing basically what could be a range-bound stock. So how do we go in and take a look at potentially playing this? Well, this is what we're going to do. We're going to go in and we're going to take a look at, let me just bring this up. We're going to take a look at AMAT. Let me I apologize. So let's go ahead and take a look at the option chain. So I'm going to go to Trade, Options, and we'll take a look at the options in implied materials. Log in, that's always nice to do. Go to Trade, we're going to go to Options. I'm going to type in AMAT. I'm going to go create my own, and then I'm going to scroll down. And I'm going to actually look at the April expiration. Why April expiration? That's 50 days until expiration. When I'm doing these types of strategies, and in general, I want to have at least 45 to 50 days. Now, I'm going to click Display Greeks because I like to see the deltas, and I want to look at all the strike prices. So I scroll down, and I'm going to take a look. Stock's trading at $36 and some change. I'm going to look at selling basically right around the 30 delta put. So that's going to be at the $35 strike. So if I go to the $35 strike, puts are on the right. So I double click in there. I'm selling the $35 strike. Now I like to do either 1 to 3 point spreads, the difference between what I'm buying or selling. In this case, I'm selling the 35 puts, and then what I'm buying. I could do $1 or I could do $3. In this case, I want to keep my capital tight, so I'm going to actually look at buying the 34. So this is a 50-day credit spread where I'm going to receive 61 cents and I'm going to pay roughly around 39 cents. Now, there's a little bit of a rub here that I have. There's one other rule that I have with credit spreads, and that is the difference between the strike price. In this case, the difference between 35 and 34 is $1. Now, if I sell these at 61 cents and buy these at 39 cents, okay, that means that my total credit is 22 cents. That's a problem for me because when I look at this spread, the minimum credit that I want to receive, if I'm willing to sell this, buy this, and take this risk on of basically 79 cents or $79 per contract for a potential reward of $21, I want at least a third of the width of the spread, so I need 30 cents. Now, for sake of example, today, I'm going to put it out there at 21 cents, okay? And again, we're doing that at a credit, and I'm going to do, let's say, 3 contracts. The reason I'm doing 3 contracts is because, remember, the difference is between the risk is the difference between the credit spreads minus the strike prices minus the credit received. So if I receive 21 cents, I have 69 cents of risk, so that's $69 per contract. If I do 3 of these, that basically means that I have around $200 worth of risk. I review the order. Sell to open the $35 puts that expire in April, and buy to open 3 of the $34 puts. I am going to receive 21 cents per contract, which would be a total credit of $63. My total risk is going to be right around $200. I know it says $300, but that's just the difference, the total amount of $1. But it doesn't take into consideration the credit received on the initial margin requirement, but it will when you look at it on your positions and also in your margin area. I got filled at 23 cents. So currently it's trading at 22 cents at 24 cents. We filled it a penny better than what the current bid is. So right now I would go into my managed positions and take a look at the AMAP position, and this is where I would manage it going forward. One thing that's to note, yes, I did this 7 cents less than that third of the width of the spread, right? So if it's the difference between 35 and 34 is $1, I want to take in at least 30 cents, but again, I wanted to show you the mechanics and the rationale. Now, how would I manage this trade going forward? Well, as a matter of fact, what I would do is that, and I'll do this right now, I would manage this trade at 50% of the total credit received. What does that mean? If I sold it at 23 cents, that means that I'm going to buy it back at roughly, let's just say, I'm going to do it at, we'll do it at 13 cents. We'll do that good until cancel, and we'll review this order. This is how I'm going to manage the trade. I'm going to buy this back after I collect almost 50% of the total credit received. So I received 23 cents. The exact amount would be 11.5, but yeah, 11.75. But I'm going to place this order. That means that I'll have a debit spread to cover this credit at 13 cents. That basically means I make 10 cents on the position per contract, or $30 per contract. On a $200 worth of risk, you're basically looking at about 1.5%. So that's the rationale behind put credit spreads. Those are the, again, the points that you want to keep here as far as critical elements of the setup. And that's it right now for MarketStream.live. Join me at 3:30 Eastern Time. I'll be back on with Tech Talk. See you then.